As we've been saying all week, we're starting 2021 with this new shorter series on the future of the economy. And for this week, we're covering my top 5 risks that we face in the first half of 2021. Monday was vaccine hesitancy. Tuesday was virus mutation. Wednesday was cyber war. Thursday, my favorite, congressional fighting. And today, we're covering a credit crunch. That's right, a credit crunch. The economic fallout from the virus and the rolling shutdowns aren't over, and these will continue to impact the United States into 2021. While the U.S. government lending programs and stimulus measures have helped stave off a longer-term initial crisis, the medium-term outlook remains somewhat cloudy for economic growth. But hey, look, with the passage of another stimulus package, the economy will definitely grow in the first half of 2021, probably like 5%. But no stimulus will cure the virus and its impact on the economy. Travel and tourism, leisure and hospitality, retail, and really any face-to-face business will continue to see losses in the new year with or without a vaccine. And because consumers have adjusted and potentially made permanent changes to their behavior. And this has serious implications on corporate balance sheets in all of those face-to-face industries. As an example, one of the biggest drivers of change, of course, is work from home, or really work from anywhere. And at this time, it's a bad habit to over-extrapolate into the future the changes that are occurring under COVID. But this is one trend that was in place prior to the outbreak and now has been supercharged. So it's got legs. Employee surveys show workers like the flexibility of work from home, and a hybrid model of workplace attendance will likely remain into the future. Is it 1 day at home with 4 in the office, or is it 2 at home, 3? Who knows? But this is one change that has critical implications for energy, transportation, office space, and apartments. Look, the U.S. is currently seeing a 13% drop in miles driven. Well, look, this doesn't seem like it's a lot, but it is a big impact on gasoline demand and oil production. On top of this, business air travel has collapsed. And if this continues, all of this continues, this would also have a lasting negative impact on oil companies and energy production in the United States. Already layoffs are occurring in face-to-face businesses and in the energy space. And yes, oil and gasoline prices have recovered from their worst sell-off of back in 2020, but what is their upside if this workplace trend has permanently changed? Already fossil fuel companies have seen their stock prices and their bond ratings take a hit. A big question is whether financially shaky firms will continue to have access to capital or lending. All right, next on the hit list is commercial real estate. Downtown office space and office rental prices are cratering in the major U.S. cities like San Francisco and New York, even in Chicago. On top of this, financial institutions with exposure to retail or retail malls are experiencing the apocalypse as shoppers stay away due to the virus, accelerating the downturn that was in place prior to the outbreak. And there have been very few CRE deals done in these groups, and therefore price discovery for how far down prices have fallen is really tough. In other words, nobody knows how far down these things are going to go. And because of this, there are big questions of whether access to funding from either investors or banks is going to happen for these malls, city and office space, and apartment REITs. Banks with CRE loans are likely to begin the process of writing down the properties and taking hits to their loan portfolios and their balance sheets. All right, the last thing on the credit crunch, with work from home or work from anywhere, are trends impacting for travel and for transportation, as we said. Sales teams have learned you don't need to travel for 3 hours to attend a 30-minute meeting with a client. And if this continues, it's likely we're going to see a significant rise in non-performing loans at financial institutions with exposure to businesses like airlines and hotels as they remain significantly impacted by the virus. This will not likely be a quick turnaround even with the vaccine. So wrapping this up, this depressing but necessary series, the hope is that with the vaccine, the global economy will return to some normalcy. Obviously, that would be good news. and extended grace periods for loans and evictions will be enough to get everybody through these tough times. Yet in 2021, these grace periods will end, and the adjustment process will begin to rebalance lending and the economy. We should not expect banks to lend and pretend at all with this situation. And this could limit credit in other areas like housing and consumer loans. And remember, with a new Congress and administration, there will likely be limits to stimulus and limits to government actions to delay the difficult and hard choices needed. Look, a credit crunch is kind of sneaky. It moves slowly, then suddenly, and impacts harshly. With this sobering thought, we end the week of 2021 risks. Phew, let's get that done. Okay, that's the last of my top 5 risks. Next week, we'll look at the top 5 economic priorities for the new Biden administration and what they mean for the future. But hey, as always, if you like these videos, click on the icon below to get more. If you want to get them every week, click on my picture to subscribe. Please share them with anyone you think would like them and benefit from understanding the future.